get comments like this all the time. So who's affording a house on $70,000 salary? A lot of people. A lot of people who are disciplined, people who don't have huge debt, people who don't have credit card debt, people who don't have car payments of over $1,000 a month. So if you are making $70,000 and your debt is low, you can afford a lot of house, okay? So there are ways to make it work, and there are ways to make it work for your circumstances. So you got to take what you have and maximize it. Pay off your debt, pay off any outstanding loans so that you can purchase a home and then use that to rent it out and then purchase the next home.
I've been trying to tell folks that for a while now. If you've ever typed into Google, how much home can I afford, and get back all types of numbers with all these calculators that are out here, well, this video is for you today. I'm going to go step by step and give you the ultimate formula that you could follow so that when you buy a house, you're going to love it. You're going to love the fact that you have your own. You're going to love the fact that the payment and the maintenance is something that you can afford. So if you've been interested in that, this is the video for you. For those of you that don't know me, my name is Robert. And on this channel, we simplify the home loan process. I'm calling this the Love Your House formula. And if you implement this to the number, I guarantee that you will never, ever, ever, ever have any remorse when it comes to you owning your home. Keep in mind that this is the best case scenario, and you can go above these numbers if you have to, because a lot of folks do. But this is the most important formula. So 3 times your income. The lady, the realtor, I believe, in the video that started this video, the lady in the video said that she gets asked all the time, you know, how can people making $70,000 afford a home? Well, if you never exceed 3 times your gross income, you're going to be Gucci. So she mentioned $70,000, 3 times that. So the guaranteed piece formula purchase price is $210,000 for those making $70,000 a year. Now, the ratio component of your payment is the house payment, which is comprised of the principal and interest if you're borrowing money, and then everything else, the TMI, the taxes, maintenance, and insurance. The total debt load, the total payments that you have coming out of your household based on your annual salary should not exceed $2,100. Now, I can already hear a lot of you out there, oh, you can't do that. Oh, yeah. Listen. Did you hear what she said? It could be done. It's whatever you want to do. And there are people that are doing it on less than $70,000 a year with a family. If you're in the camp that you want to think that you can't do it, well, this video is not for you. We're talking to those that want to buy and want the guidance and the information that they need to implement to get there. I digress. So back to the ultimate formula, 36% of your gross income should not leave your house for all of your bills, total. That's the principal, interest, tax, and insurance payment here. And your remaining bills shouldn't exceed $2,100. Okay? Does that make sense? Now, you don't have to put 20% down to buy a house. In fact, there's programs that you can finance 100% of the purchase price if you are a qualified veteran or surviving spouse. If you're a regular, good citizen, and you're buying a home that's in a USDA eligible area, you don't have to put down a down payment. You can finance 100%. And then FHA and conventional offer a 3% down payment if you're a first-time home buyer for conventional, and as little as 3.5% for FHA. So the traditional financing vehicles that are out there, you don't have to put 20% down. But we're talking to y'all that want to do the thing and have just great peace. I'm talking to you today. And so 20% down payment. Okay. 20%. Let's do the math. So if 210,000 is the maximum purchase price, that's 3 times my gross income, then the 20% down payment is $42,000. A lot of you guys are out there, oh, where I'm gonna get 42,000. Not talking to you guys, not talking to you. Trust and believe. There's a lot of folks. I just talked to a 27-year-old, right? Actually going through his pre-approval right now. Got $60,000 in the bank. He got a wife and 4 kids, and he's the only one working. You could do what you want to do, right? So we're not talking to those of you that blows your mind. We're talking to those of you that this resonates with. This is for you, okay? And so that's $42,000 down. Now, this is going to allow you, I'm going to put a star here. This down payment, that's not counting the closing costs as well. This is just a down payment. See, that skin in the game is what really differentiates a lot of buyers, because this 20% is going to allow you to forego, if it's a government loan, FHA, the MIP, that's what we'll call it. If it's conventional, it's called PMI. But that's those insurances, great insurances that allow those of you that can't put the 20% down to still get into a home or get onto the housing ladder, and then chip away at that thing until the time that you can refinance out of it. But this is the sweet spot because you don't have this extra payment that's not going towards any of the principal reduction, but it's allowing you to deal with the risk factor of not having any skin in the game. Those of you that really want to be successful, those of you that don't want to be on TikTok crying and lamenting about your house being too much that you can't handle because of the taxes, maintenance, and insurance that fluctuate, the TMI part of the payment, that skin in the game prevents that. And it tells you that you're really, 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 really ready to be a homeowner. And these folks are less apt to walk away. That's what that skin in the game helps you prevent. It also prevents you from buying too much, because now you have some skin in the game. Last thing is this: 1%. 1% of what, Rob? Of the total purchase price. So that 1% is the maintenance factor that you're going to factor into this total debt, the back end ratio. I'm talking about car, student loans if you have them, installment loan, other debt that you're making monthly payments on in the house don't exceed that $2,100 if you're making $70,000 a year. That, ladies and gentlemen, is the piece de la resistance that will afford you a guaranteed, beautiful, successful time of ownership. And then hopefully you do what the young lady said at the beginning of the video: you don't sell. You rent that house out, because that is the foundation to you building wealth and creating more margin for you and your family. I want to give 4 or 5 examples of different states where you can buy houses for $210,000. But more importantly, show you how I would go about looking at, in whatever state that I'm in, and what I would be looking at on these online portals that provide this information for you, so that you can have that winning formula. When you go on to Zillow, wherever you're at in these United States, if you notice here, I have Dallas, Texas. So we're going to do Dallas, Oklahoma City, New Orleans, Louisiana, and someplace in Mississippi, kind of these southern states. Again, you can do this exercise wherever you're at. If you want me to look at a certain area like this, put it down in the comment section and we might do so on a future video. For our example, I just clicked this first one because it's 210. And so this is what I want you guys to know. Quit looking at the pictures and all that. We're going to get that later, right? We're on this channel, we're trying to teach you how to be successful homeowners. And although the pictures are going to attract you and where it's at, that's a part of it. But the part that's really going to make you peaceful is what I'm about to show you. So you want to scroll down, and where it says show more, This gives description and stuff. This is that marketing. This is that cap section in a lot of instances. But what you want to go to is the data, however you say it, the facts and the features. So we want to blow this up. And for a lot of you that watch this channel, I have a lot of single ladies that watch the channel. Shout out to you all. The reason I brought that up is a lot of you all have a trepidation, a fear of, man, if something breaks, well, older home. So here's the deal. Older home does not necessarily mean problem. What we have to start looking at is the ages of the home. And that's where I was going with that. You want to scroll down and okay, this home was built in 1948. So it's been there for a while. But for a 1948 home, it looks like it's been updated and upkept. So if I'm looking at an older home, the benefits of older homes are this. You're not going to have any HOAs because that's an additional fee. And there's a ton of videos where a lot of you guys don't want nobody telling you what to do. And you don't realize they're not trying to tell you what to do, but the HOA has rules. So if you don't want those rules, that's why I like a lot of older homes. And that's one less cost that you don't have to factor in. Then I'm looking at this section. It's public sewer, public utilities, all of those things. And newer homes, a lot of times because it's being developed on the outskirts of the city, and the city is saying, you know what? You got to have an HOA. You got to have these special assessments because we, the city, are not going to incur the cost, developer, builder, for you to build these new things. But what we is going to do, we going to annex you and we going to take the property taxes for the schools and so on and so forth. That's a whole nother video. As you could tell in my sarcastic response, I'm not too fond of that, right? But it is what it is. So they annex. And so when you're going newer and out further, you have to understand these ongoing costs for the infrastructure, not only in your neighborhood, but in the surrounding areas that's growing. That's the name of the game. So when you buy in a more established area, all of these things have been accounted for. That young man that I just mentioned to you earlier in the video, $60,000. In fact, in 2013, okay, he bought a house in an older area of the city where he's at, where a lot of us wouldn't want to buy. Probably got it for about $60,000. The house is paid off. Now he's going to be renting that house to a lot of you guys out there for $1,500 a month. And if you want to stay there, you're going to pay it. Facts. And now he's getting ready to buy a much larger home, about $300,000, and he can afford it all day, every day, twice on Sunday. That's the formula. A lot of you guys are looking for excuses not to do what arguably is very intimidating and it can be scary. But all I ask you to do is examine yourself and look back 10 years if you're over 35 and say, you know what? Was it less expensive 10 years to buy than it is now? And what would my housing cost be now, even with increases in taxes and insurance, opposed to what I'm paying in rent over the last 10 years? That's 100% interest because you get none of that money back and rent is going up. Just ask yourself. And again, this is not to get on you. I'm hitting that nerve to get you to think, because you keep listening to the wrong people, right? And I want you to win. You want to look at those things, okay? Because we're just trying to find that perfect number for you. Here's the last thing that most of these gurus aren't going to tell you, but I'm going to just break bread with you. This is just some of the stuff that we do with those of you that decide to work with us. And we partner you with a realtor that knows a lot of these things to help you get the best deal. But as I said, no HOA. They have a lot of city features that aren't going to be newer, ongoing, increasing costs. It's just maintenance. And all those annex places are really helping the entire city. Real talk. And so this is where I want to get to, the taxes. Now, this $210,000 house in Dallas, right? Taxes are $39.20. Now, taxes and insurance are one of the things that are a part of the TI in the PITI, principal interest, and most of your cases are not going to change because they're fixed interest rate loans. Okay. But the taxes and insurance and potential HOA is. So let's look. Taxes in Dallas for a $210,000 house, $39.20. When we jump over to New Orleans, Louisiana, $210,000. Just want to show you different locales and the different taxes. Annual taxes here, $23.55. Let's jump to Oklahoma City. Annual taxes here, $13.15. I'm gonna scroll down real quick. That's a $210,000 house. And then somewhere in Mississippi, I don't know where this is at. Where is this at? Ocean Springs, Mississippi, wherever that's at. $210,000 house. Taxes are $1,034. So I say all that to say this: where you buy matters. And a lot of you all, the location that you're buying in, you got to quit listening to these folks talk from a fear standpoint nationally, where they always are citing Florida, like the Miami area, that MSA, or up in New York and some of those higher cost areas, or California. You don't live there. Where do you live? And this is how you should be looking at Zillow before you get excited to look at anything, because we got to start getting excited about, can you afford the house, so that you can have that formula, the love your house formula, right? That's what we're going to call it. So hopefully that makes sense. I want to ask you a question. What are property taxes in the area that you live in? Are they high or are they low? If you could put that down in a comment section, along with what state. You could just do the state. We're not trying to surveil you or anything, but just interact, because that's a very important question. And I'll tell you why. I was going to save this, but I'm going to tell you why. Let's go back over here. You guys have competition. So this is U-Haul, and this is a report that they come out with every year. We're not the average Joes around here. We do a lot. It's more for me than just giving you a number and an interest rate, trying to help you win. But as you can see here, this is the 2026 report. But U-Haul, their growth index, they give top U.S. growth metros and cities for 2025, right? It comes out January of the new year. And here's the deal. The reason that this is important, and I'm showing you these things, especially if you're in some of these places with lower taxes, so on and so forth, is you have competition coming that you don't even know about. And for all of the renters that are lamenting about the cost of rent and going up, this is why you need 3 times the rent, so on and so forth, because you have people coming from higher cost areas, in a lot of cases, moving to areas where you are, and you don't realize, man, why stuff get more expensive? Because you're an incumbent and you've been in a race to the bottom. But see, they got people are coming. See, that's the beauty of this internet, that most of you guys are using the wrong way, respectfully. But you can see here, these are one way U-Haul rentals, and they track it. And I like stuff like this better than the so-called gurus that don't know what they're talking about. None of us do. We got to wait and see what happens, right? And there, Dallas, Houston, Austin, Charlotte, Phoenix, Nashville, Charleston, Raleigh, Atlanta, Brownsville and McAllen, Texas, Lakeland, Florida, Boise, Idaho, Palm Bay, Minneapolis, Spokane, San Diego, San Francisco, Jacksonville. You could get a great idea of the top metros, and then you can even drill down, because U-Haul has a very good pulse on where people are going. So if you're in these places and you're feeling that rent increase, the old man just told you why. And this is even more the reason why, if you want to buy and you're able to, not talking to those of you that won't, 6 out of 10 of us buy. The 4 that don't, I've told you all day and twice on Sunday, you better make sure you're doing something with your money for your future self, because these homes that we're talking about, for most of us, is a forced savings account. And if you don't believe me, look at your savings over the last 10 years, you renters, and you ain't got none. Most of you, especially all of you that keep putting in the comment section, well, I do businesses and invest the rest. No, you don't. That's what you heard. I could just look at your bank statement and tell. Okay. And the 1% of you that do that, shout out to you. Y'all need to start a channel and help these other folks that don't want to own anything, really help them take care of their future self. This is why these things are coming down the pike. And this is why I'm showing you guys how to look at this data from Zillow to help you really determine your formula for winning. I have a test that I created. It's called the Peace Test that you can take. It's free 99. The link is in the description of this video. I admonish you to take that test for those of you that want to become homeowners to help you determine where you are. I'm super ready. I'm ready to go right now. I'm kind of right here. I'm not there yet, or stop the present. I need more work. That's the gist of the test. Takes 5 minutes. It's free. Link is in the description. This will further help you determine what you need to do next. And depending on where you are on that test, the next thing you guys need to do is schedule a consultation. As I stated earlier, 20 years in the business, simplifying the home loan process for those of you that want to buy. NMLS license number 180100. If you're wondering why your approval amount and your comfortable payment amount feel completely different, you want to watch this video right here where I break down why most loan officers approve you for way more than you should spend. You guys be good to one another, let grace abound, and stay blessed. Indeed.